Good afternoon and welcome again to Digital Look TV. With us today is Craig Erlam from Alpari UK. Craig, good afternoon. Thank you for joining us.
No problem.
Okay, let's see. In the last couple of weeks, we've seen quite a bit of volatility, gyrations in equity markets. Steep fall in the S&P 500, a very steep fall in the FTSE 100. Now we've bounced back quite well. Can we truly believe in this bounce, or are we just setting ourselves up for another fallback?
We could potentially be setting ourselves up for another fallback. I think there's a big difference of opinion amongst analysts and economists, not necessarily one against the other, but just among people at the moment, in the sense that some people think I think we saw a fall of around 7% in US in the season, the S&P 500 in the Dow. Some people were calling for that 5 to 10% drop and think that the reaction to the Fed tapering has been ample, and therefore we are seeing it push higher now based on improving fundamentals. But I've also seen plenty of calls where people are saying we've not seen anything like the kind of drop that they were expecting, and they can still forecast another 10% drop. But I think what we have seen now, and what I've gathered from the reaction to a lot more of this talk of tapering from the Federal Reserve at the end of the year, and when you combine that with the reaction that we see to employment figures and to growth figures, is that there does seem to be a much bigger focus now on the fundamentals. We saw the non-farm payrolls came out much better than expected. The participation rate in the unemployment figure rose, despite the fact that saw an increase in the unemployment figure as well. But obviously important that we're seeing the participation rate pick up. And these positive factors actually prompted a rally in the S&P 500, a rally in the Dow, and also like Europe and Asia as well. So I think that suggests that we are seeing that change, that we're moving away from people from the Fed determining which way the markets go. With if we turn the taps on, the markets go higher. If we turn the taps on, it's lower. And I think there's more focus now on the fundamentals, which is why I think corporate earnings season, for example, over the next couple of months is going to be key in determining which way the markets are going to go for potentially at least for the next few months.
Okay. However, we do have, for example, Goldman Sachs, Credit Suisse. They're calling for a 10-year raise towards 3% towards the end of this year. Some people are afraid that they'll go even further, much higher. Perhaps some people even talk of 3.5%. Is this what perhaps has scared the Federal Reserve Chairman Bernanke a little bit, and that's why he was so dovish in his speech last night? If they go that high, it would seem very difficult for equities to keep advancing. What's your take on that?
Well, I mean, I think Bernanke's kind of caught between a rock and a hard place at the moment. I think he's very keen to keep the taps on. I think he still sees the economy as only part fixed. I mean, again, like I said, we saw that improvement in the participation rate, but the participation rate has still fell by 2% for 25 to 55-year-olds. Now that's the prime working age, and that's what it's fallen over the last couple of years. We're still seeing far more part-time employment in those figures, which essentially make it look far better than what it actually is. And I think Bernanke sees these issues in the economy and therefore wants to keep the taps running, not just so we can get the unemployment rate down to 7%, 6.5%, but we can actually see an improvement in the economy that's sustainable. So I think there's a lot going on inside Ben Bernanke's head. He's then got obviously a lot of FOMC members calling for the taps to be turned off altogether by the end of the year because of the risks and the costs associated with QE3. But then on top of that, like you say, you've got Treasury yields now creeping that little bit higher, so he may be wanting to come across a bit more dovish to push these yields a little bit lower. But then on the other side of that, the more dovish he is, then that has the potential to push these equity markets back towards these all-time highs. And I think there's a lot of people out there, and that includes myself, who think that one of the reasons why he began to come across more hawkish a couple of months ago was because we did see these equities at record highs, and then you've got the prospect of an asset bubble, of an asset bubble here, which is not necessarily justified. I mean, yes, company earnings are improving, but a lot of that is driven by efficiency savings, by making cuts to staff, and it's been helped a lot by these lower interest rates as well. But then if you look at, say, the revenue figures, they're much poorer. The economy's not performing as well. Investment isn't where it should be. So there's so many. The economy is so fragile that it doesn't necessarily justify equity markets being at these all-time highs. So I think, like I say, rock and a hard place is trying to keep certain people happy, but he's trying to keep maybe these equity markets away from these unsustainable record highs. The last thing we need is another market crash,
Right.
because he's left the taps on too long and let it go too far. And now you've got the other thing of, hold on, now bond yields are getting too high. People have overreacted to these to some of the comments a couple of months ago, and now he just needs to ease concerns here and just find the right balance, and I think that's what he's trying to do right now.
Okay. On the risks, as far as risks for the markets are concerned, on the one hand, yes, we have treasury yields, which have been rising too fast, too quickly, but also oil prices. They've come up quite a bit. It's because of the situation in Egypt. Just how much of a risk is that? How far might they go?
I'm not necessarily convinced at this stage that the Egypt situation is necessarily too big of a risk. I think one thing which we do tend to see in situations like this is we do tend to see a bit of an overreaction to this news. I was speaking to a trader the other day who suggested that the reason why we've seen oil prices rally so far is not necessarily barely anything to do really with the situation in Egypt. Okay. What it is it's almost, you've got a case where the oil prices are at these big resistance levels on a technical standpoint, and the release of this news in relation to Egypt or any kind of crisis we get in the Middle East encourages traders to buy into this resistance level. It pushes through key levels, and then we do see an exaggeration of that price. You've got people buying towards the next support level. You've got people stops being hit, which push it to these high levels, and all of a sudden you get a big overreaction in the prices. I think we've seen a big overreaction in the oil prices. That's not to say it can't go a little bit higher again, but I think there's going to hit a point now, not necessarily straight away. We saw it reach around I think Brent crude hit 115, 120 last year. And I think if we do see it push higher again and hit these kind of levels, then you can start to see the other sides of this, where you see it start to have an impact on the economy, where you start to see it squeeze people's real incomes, and it could even happen below there. It could happen around 105, 110, which is around where it's trading at now. Quite because close. I think one of the ways in which the US economy has benefited this year, it's performed well this year despite that 2% payroll tax and some changes along the lines of the sequester, yes, and also the fiscal cliff at the end of the year. I think one of the things that's really cushioned the blow has been these lower energy prices, these lower oil prices, and therefore they've not necessarily felt the full impact of these changes this year. If we see these oil prices now push higher, then we could start to see people's real income squeezed, and that could have an economic effect, and therefore then you get this whole supply-demand ratio coming back. I mean, I think again, we've seen recently, I think almost not exaggerated, because the data doesn't necessarily lie, but I think, say, the crude inventories as well, we've seen a big reduction in the crude inventories, which I think is almost exaggerated the rally in the oil prices. I think there's been an overreaction almost to these again, because it's one or two figures. Until we start to see a longer term improvement, then I don't think it necessarily justifies the levels which it's at now. If we see these inventories come down again, then it could potentially just bring these prices straight back down again. But I just don't think these higher oil prices are sustainable. I do think they are going to come back towards that 100 level in a few months' time.
Fantastic. All right, Eurodollar. With interest rates in the Eurozone staying low, in theory, in the US, they've been trending higher, more or less, and they might keep on doing so, even if more slowly. However, each time the euro-dollar pair nears 128, it bounces right back up. Is what might be the trigger for a move lower? What might be the time frame for such a move? Should investors or speculators bet on a fall now or hold off on that? What are the levels?
Well, you said it then. 128, I think, is a huge level for a few reasons. Firstly, there's an ascending trend line on the chart which falls at 128. But then below, aside from that, we've also got it's also a previous support. It's also been a previous support level on a few other occasions. And I think even more important than that again is the fact that the next support on that euro dollar is there's a small support 125, but below that's around 120. So I think there's a lot of buyers at that level, because they know that if we do see it break through that 128 level, we could see quite a substantial drop. So I think that's a major level at 128, and I think that's the main reason why it's held up so long, is the fact that the next major support below here is substantially lower. But how long till we see it broken? I mean, I do think we will see it broken in the longer term. We can't have Fed tightening, or not tightening, but tapering and the potential for the ECB to ease or loosen monetary policy and not see that have a negative impact on the euro-dollar pair. But we've seen consolidate. We've been calling for these moves lower in the euro-dollar for such a long time now, and all we've seen instead is more and more consolidation. We tend to see they tend to get stuck in a range a lot between 128 and 130, and then it pushes up between 130 and 132. Briefly, sometimes between 132 and 134, but now we are seeing that consolidation. That we are seeing that we are seeing that range tighten more and more. I think it's at 130 today. If it closes above 129.50 at the end of the week, I think we could see a push up then towards 132 again, maybe even 133, 134. Below 129.50, then I think we're going to see a lot more pressure on that 128 support level.
Interesting. Okay. Going back to the theme of volatility, rapid changes in sentiment in equity markets, but now we're not looking at the U.S. Let's look at home in the UK. I have here Money Management, the magazine, the July installment. The front page, from austerity to prosperity, the UK economic outlook. Again, just even a quarter back, people were saying that Mark Carney would have to do another installment of QE very quickly. The UK economy, the IMF had cut the outlook for it. It was going nowhere. Certainly nowhere quickly, nowhere positive. And now all of a sudden there seems to be a lot of optimism in the air. Do we believe this?
I think we don't want to get too carried away. I think it's important, and this isn't just the UK. Obviously, the UK, maybe not necessarily just the UK. Obviously, the UK's been under a lot of focus because of the government's commitment to austerity into trying to get the budget back into shape and trying to sort out the fiscal deficit and the debt problems that we've had in the country. But I think this is a global issue. I think it's hard to get too carried away in the US. We've seen there was a lot of optimism at the start of the year in the US with growth, and we've seen 0.3% in the first quarter. We've seen 1.8% after that. We've seen a lot of in Eurozone. Every time we start to get a little bit carried away, something else goes wrong. There was a lot of optimism surrounding China. I think last time we were here, me and Ishak were talking about the prospects for China this year, and at the time I was quite pessimistic, and I'm even more pessimistic now than I was back then. So I don't think it's just focused on the UK why we can't necessarily get too carried away, but at the same time it is encouraging what we have been seeing recently. We saw early this year the improvement mainly in the services PMIs, but that does contribute 70% of our GDP.
Yes.
So there's obviously reason to become optimistic there. But then we've seen improvements elsewhere. We've seen improvements in the manufacturing, the construction PMIs, which has been a weakness for the UK economy for the last couple of years. Even if it is only a small portion of that GDP figure, it is important and it can provide that extra boost to the economy. But then we've seen an improvement in the hard data as well. So we've seen an improvement in, say, retail sales in the manufacturing figures. We've seen improvement in GDP figures. We expected 0.1% growth in the first quarter. It came out 0.3. It's only a marginal improvement, but all of a sudden now you're talking about higher growth rather than triple dip recessions, and mentally it makes a huge difference. It makes a huge difference for confidence when you open the front page of that paper the day after these GDP figures come out and you see triple dip recession. You go home, you tighten your purse strings, you're a bit more careful. You remember what's happened over the last few years. You don't want to get in these kind of debt issues again. You don't want to just be unemployed and have no money left. Or you open the paper and you see the FTSE's at 5-year highs, the S&P, the Dow's at all-time highs, the UK grew faster than expected, people are more optimistic for the next few months. And again, we're a service-led economy, we're a consumer economy, and you go out, you spend, you feel more confident, you see your house prices now on the rise, whereas over the last few years it's been on the fall. All these things contribute to an improved confidence, not just in consumers, but in businesses as well, and then you get this spiral where things start to improve, and this improvement encourages more spending, more investment. So there is encouraging signs here, but then again, even though it sounds like I'm getting carried away, it wouldn't surprise me if I'm back here in 3 months' time and we're talking about the potential for the UK to fall back into recession. Everything's gone wrong, and now Mark Carney's got the weight of the world on his shoulders, and he's basically got to single-handedly bring the UK back to growth again. So,
okay. Now, another country which of late has been going through some difficulties is the People's Republic of China. You were telling me before, indeed, a couple of months ago, you were not very optimistic on this economy. The latest batch of data has been rather poor. I've heard some market chatter, some reports, some analysts' comments saying that perhaps even next week there's a policy meeting and they're looking for Beijing to possibly announce new stimulus measures. They were talking about a reduction in the bank reserve ratio. Do you think we'll keep on seeing more weak data? Is there a probability or a risk that you could see a policy mistake in China, that they will take slowing the economy too far? Is that a scenario we need to take into account?
I think that's always a risk when you're undergoing the kind of restructuring and the reforms, which is the essentially is the target of this new government in China. Then there is always that risk that you are going to take it too far. You are going to see a hard landing in the country, and all of a sudden you've got a very big job ahead of you to get yourselves back to the kind of growth. And when you've got that surging unemployment, you've got to try and reverse that again. There is always that danger. I'm not convinced at this stage that we are going to see that. I think while it is going to be maybe a harder landing than what was maybe initially planned, I think that it is going to be contained. I think it is going to be dealt with by the government. Like you say, there's chatter in the markets that there's going to come up with some kind of fiscal stimulus. They do want to move away from that investment export led type export economy into a more services led, into a more
services consumption.
Yeah, exactly. But I think the fact that we're seeing this chatter now, where they can see the threat coming, they can see these lower growth rates, they can see the problems which they've got with the manufacturing sector, with the export figures being exaggerated due to.
Do you believe them anymore?
I've not paid attention to the trade figures for a while now, since the first quarter when they went entirely out of proportion, and the chatter began that there could be people fiddling with these numbers. I think I really stopped paying attention to them then, but I think even the Chinese government underestimated what kind of an impact these credit inflows were having that were being disguised as genuine exports, and then so I think they really underestimated. Now they're starting to crack down on it. That's why we're seeing such poor export figures. We saw the trade balance data the other day. Headline figure looked great, came in slightly higher than expected. It was 27.1 billion.
Indeed.
But then you saw a significant drop in exports when you expected a significant rise. And also concerning was the drop in imports. That's very concerning for Australia, who are very reliant. But then it also suggests that domestic consumption is not as necessarily as strong or as reliable. I think one of the things that's going to make this transition from export investment led to consumption, especially domestic consumption led, is going to be they need to see that continued pickup in domestic consumption. And I think one of the things that the drop in imports has shown is that maybe it's not as reliable as was first hoped. So that's why I think we're seeing now this talk of a fiscal stimulus package. I think the government know that they can't go cold turkey on this. They can't invest loads of money, have loose monetary policy, have the People's Bank of China flooding the system with liquidity, have these low interest rates, and then just say, right, no more liquidity, no more investment, it's down, we're just going to change it on the spot. But you can't go cold turkey like that and expect it to work out well. So I think that's why they're now saying we're seeing this threat, and what we're going to do is we're going to make this a little less painful, and we're gonna make this a bit more gradual, and we are willing to spend if need be, but we'd rather not.
Okay, you touched on something which is also very interesting, Australia. Slowing down in the Chinese economy is not good for Australia. Last time you were with us, you were telling us go short the Aussie dollar. Would you stick with that for now?
Now it's a little bit more difficult. I do think there is more downside to come. Whether it's going to come straight away, we may see some form of correction. That I think that move was really exaggerated to an extent. There was a huge move lower in the Aussie dollar. I do think we may see a lower correction, but in the longer term, in 3-6 months, I do see it moving back below 90, maybe even towards 88, because the simple fact of the matter is the Chinese economy is slowing. There's no denying that. That does have an impact on the Australian exports. That does have an impact on the Australian economy, on commodity prices. All these things which contribute to those stronger GDP figures in Australia are being hit. We've got interest rates at record lows. We've got the RBA talking down the currency, despite the fact we've seen this massive pullback in the Aussie dollar. I think there's a big potential for rate cuts, at least 2 more rate cuts this year. But then, even putting that to one side, we've got the political issues in Australia. I think is it Kevin Rudd took over as Prime Minister took over the party leadership only a couple of weeks ago. Only a few weeks before the election, because they believe the party had absolutely no chance of winning. I mean, this is it reeks of desperation when you're bringing back a prime minister who lost the previous elections to lead the party into the new election and replace the current leader Julian Gillard only a few weeks before the next election. It just there's something really not right in Australia at the moment, and I'm not convinced that they know how to fix it, especially without a revival in China.
Interesting. So unfortunately, that's all the time that we have for today. But Craig Erlam from Alpari UK, thank you very much for your time, and we hope you will join us again.
Of course, no problem.
And thank you everyone for tuning in for another week, and we hope you too will join us again next week. That's all. From Digital Look TV in London, goodbye.